I guess I want to get started with just something simple here. When you look at 2018, equities, is that still the place to be?
We think it is the case. We think equities should outperform bonds for next year. Maybe not in the same magnitude we have seen this year, but given our growth outlook and also our forecast on earnings growth, we think equity should be the asset class to look at for next year.
And when you look at earnings growth, any specific parts of the Asia Pacific that stands out to you? I mean, Japan was quite exceptional. Southeast Asia's been solid as far as growth. What are your top two?
Yeah, so we still like North Asia over Southeast Asia, I have to admit. We have been calling for North Asia for some time already. So when you look at, for example, China, Hong Kong or Taiwan, the earnings growth this year has been, as you rightly said, already outstanding, and we think this can continue into next year. So what we like here is in particular China and Taiwan for next year.
Now, when I look across what's been happening the past week and a half, I mean, certainly there's been some rotation out of the big tech plays for various reasons. The chip makers, the Tencents, the Samsungs, again, for various reasons. Have you been advising your clients to start taking profits as well?
Indeed. I mean, when you look at especially the tech stocks, I mean, there is a tremendous rally. So actually, we have been advising our clients a couple of weeks ago already to take some profits. But longer term, we're still positive on the tech sector. But given that strong rally, it's never a mistake to pull out some money.
Now, you talked about China and Taiwan as two markets that you like. Do you buy the index, or is there anything specific within those two markets you like?
Yeah, I mean, of course, we are looking at the so-called new economy. So technology, as I mentioned before, was one of our biggest sector calls for this year. And of course, Taiwanese technology companies also benefited a lot from the Apple new iPhone launches this year, and we think, as we can see, the demand is quite robust. We think this can also last into next year. So this is one of our major calls. For China, we are also looking, especially also consumer names, because we think here retail sales and overall consumer confidence has been stabilized over the past few quarters. So this can also be a sector which should outperform the markets as well.
So when you say China, are we talking A shares, or are you looking MSCI China?
We are more looking at MSCI China, to be honest. So we are looking more for H share than A share.
And your outlook on rising bond yields in China, I mean, it's you can almost make the argument there, Tuan, that it's almost on purpose what they're doing, of course, to sort of just take some of the froth out of this, a lot of the leverage that's taking place there. But the question is, does that become disruptive?
I mean, rising bond yields is clearly something we are also looking at, but as you rightly said, I think this is part of the government's policy to continue with the deleveraging, something we have seen for the past 12 to 18 months. So I think the markets have digested this much, much better than compared to 2 years ago. And we think, given how robust Chinese growth is, we don't think this will be a disruption to the market. So hence our still positive outlook on China.
Now, virtually everyone we've asked on what they thought was the biggest risk to this trade rally, their answer was always the same. It was faster than expected inflation. First, do you subscribe to that view? And second, do you actually see that coming within the next quarter?
Not really. I think, of course, China also benefited from the global trade recovery, like many other export-oriented countries, in particular European ones. So we think, given the overall and for the first time since the financial crisis, global synchronized growth recovery, I think China is in a very good position to benefit further from this global trade recovery. So hence we don't really see much further noise on this side.
Now, conditions today are, I would say, almost perfect for this risk trade, in the sense that anything that changes from here almost seems counterproductive to risk assets. I mean, do you get a sense when you talk to your clients that 2018 will not be the same as 2017, and do you think you need to ratchet down their expectations on returns?
That's what we trying to do. Obviously not so easy as you can imagine given the outstanding year we have so far. But I think our clients and most of the other private and also institutional clients, I think there is still some skepticism in the markets, which is quite good. So hence we haven't really seen this overly kind of bullishness in the markets. As you also pointed out, it looks to be almost too good to be true, but there are still, of course, risks around which we also have to monitor quite closely. The tension, just to name a few, the tension just surrounding North Korea has just recently picked up again, so something to watch out. And then on the political front, not much in Asia, but more like in Europe and US, something which can also cause more volatility in the markets.
Now, I'm sure you've been asked about this, Bitcoin and cryptocurrencies. What's the position of the bank, and would you recommend me even taking a very, very small exposure to Bitcoin?
As this is not an official currency, our stance, of course, is we can't and won't do any recommendation on Bitcoin. Sorry.
All right. Now, it can't all be good. What is one emerging market or developed market that you suggest I don't dare get anywhere near in 2018?
So developed markets, something, if you talk about some risky countries, so in Europe it will be clearly Italy, given the upcoming election. As I mentioned before, this can cause some volatility. In Asia, I would say we used to be quite bearish on Malaysia, but it has also turned around. So hence we have also been here a bit more positive. A country where we would maybe a little bit more careful would be Thailand, because if I compare Thailand to Indonesia, where I'm currently am, or Malaysia, it has somehow falling back because of various reasons we have witnessed over the past few quarters. So something which might cause some underperformance of a country.